Okay, so we can go ahead and post that up. Chapter 4, I guess this will be part 3 of chapter 4. If you're trying to look at something from the beginning of chapter 4, that's actually under the chapter 3 module, because we finished chapter 3 and went into 4. And then you'll see chapter 4, part 2. That was our meeting on Tuesday that I have put up. And then you'll see part 3. This should wrap up chapter 4. Okay. Or maybe sometimes I call it conclusion. Just so you know that there's not another part coming. Okay. All right, good. So what we want to do now as we finish up our discussion of consolidation is start to talk about what happens when there are intercompany transactions. How do we eliminate those intercompany transactions? And so we're going to sort of go beyond car in big now, which really was focusing more on the balance sheet than anything. But what about other transactions between the parent and the subsidiary? How are those eliminated? And we're going to look at the typical eliminating entries, and they're pretty easy to understand. And remember, we're taking sort of a component approach to how we're understanding consolidation. So even though consolidation is often contemplated and talked about like this whole entire blown up process into which you successfully prepare a set of consolidated financial statements that balance perfectly for the CPA exam, remember, we're just trying to get as many points as we can to make sure we're doing a good job on that area so that it doesn't prevent us from passing the exam, which of course has many, many different subjects on it, right? Okay, so with that, let's go ahead and let's take a look at the entries to eliminate intercompany transaction. Of course, I got to set my view here to full screen. Okay. All right. So these are pretty easy, guys. I want you to flashcard them, but they are not hard to understand. Okay. If you have intercompany receivables, you eliminate 100%. Okay. Intercompany transactions, payables and receivables are eliminated 100%, the entire amount. If there has been borrowing through bonds between the entities, lending through bonds, you'll debit the bond payable. You'll credit the investment. Obviously, if I bought the bond, I'm an investor. And if it's a parent subsidiary type relationship, then you'll get rid of that investment account. Any accrued interest between the two, accrued interest receivable payable, is eliminated. Now, be careful with the dividend. We eliminate dividend payable if it is a dividend that's being paid from the parent to the subsidiary, from the subsidiary to the parent. But if we have a non-controlling interest, then the subsidiary would be paying dividends to those outside. We still report that portion of dividend payable. We're still going to show that as a subtract from our retained earnings for our non-controlling interest, because those dividends are going to outsiders. So if it's a dividend from the subsidiary to the parent, you only eliminate that part of the dividend that is going to the parent. The part that's going to the non-controlling interest would still be shown. Okay. Okay, good. Now you come over and we talk about simple income statement eliminations. Okay, and so let's just take a look at some of those simple income statement eliminations. Okay, and let's just take a look at what happens with intercompany merchandise transactions. Okay, so what happens? The total amount of intercompany sale and cost of goods sold should be eliminated for the purposes of our consolidation. In addition, the intercompany profit must be eliminated from the ending inventory and cost of goods sold of the purchasing affiliate. Okay, so go ahead and flashcard that. Okay, and we're going to look at an example of that in a second, but just think about this, just visualize this a little bit, and then we'll look at the example. I have purchased inventory from my subsidiary, let's say. Okay, and my subsidiary sells me that inventory with a profit included in there. Then I turn around and I do what? I sell some of that inventory but not all of it. Well, now I have profit, right, sitting in my cost of goods sold, and I have profit sitting in my profit between the parent and the subsidiary. The subsidiary's profit is sitting, in that example, sitting in my cost of goods sold, and is sitting in my inventory in that example. Well, I've got to eliminate that profit. Okay, so let's just go ahead and let's take a look first here at this journal entry, and let's flashcard that. And we've got intercompany sales. We're going to eliminate 100% of that. If there was any profit in beginning inventory, that has to be taken out of the retained earnings because you can't sell stuff to yourself at a profit, right? Then we will go ahead and credit the intercompany cost of goods sold. And then the parts that I was just talking about there in our little visualization, any amount of profit that is in cost of goods sold for items that were sold, and this period, and any amount of intercompany profit that's in ending inventory, that has to be eliminated. Okay, so what I want to do is come over to the next page. Okay, and let's just walk through this example. And I think once you kind of walk through this example, you'll see that it's not that bad. Okay, so we've got this Garrity Corporation owns 100% of Olinto Corporation. Garrity sold inventory with a cost of $1 million to Olinto for $1,100,000. Okay, so when you're looking at that, I'm going to highlight that number because we've got some intercompany profit in there, right? Okay, the year-end ending inventory of Olinto included goods purchased from Garrity for $660. Olinto had remaining account payable balance of $200,000 on December 31st. And then they want to know the eliminating entries. Now, first, they're just showing you the entries on the individual company's books here, right? So what happens? We've got an account receivable of 1.1. We've got the intercompany sales of 1.1. We've got the intercompany cost of goods sold gets debited for $1 million, credited for $1 million. That's the cost to Garrity. And then on Olinto's books, Olinto has inventory now 1.1, and they have the account payable. Okay, now they tell me to go through some steps, and first step they say is to calculate the intercompany profit. Intercompany profit here is the 100,000, right? It's what it was sold to Olinto for minus Garrity's cost. That gives us 100,000 intercompany profit. Okay, now we go through, and let's just first take a look at a couple parts of this journal entry that are just pretty straightforward for us. Notice we get rid of the intercompany sale, the 1.1 million. Okay, so that is basically taking away that sale because you can't sell stuff to yourself. You don't have sales to yourself. Now we're trying to consolidate into one company. We also do what? We also get rid of that cost of goods sold up there. Okay, the cost of goods sold, we got to get rid of that because you don't have a cost of goods sold if you didn't sell something. They didn't sell it because they sold it to themselves. So we get rid of the cost of goods sold. We get rid of the sales by that part of the eliminating entry down here. Now, just to deal with the easy stuff here, they tell us that there was still, where do they tell us that? There's still 200,000 outstanding that Olinto still owes Garrity. So of course you don't owe money to yourself. So we get rid of that intercompany receivable, the intercompany payable. Okay. So now we're down to what? We're down to this part right here. Okay. How do we get rid of the intercompany profit? And they told us up there that what? There was still 660,000 sitting in the ending inventory of Olinto in this case. So if it was 660,000, right, at the amount that they paid Garrity, and then the sale was 1,100,000, that means that what? 60% of the inventory at Olinto's cost from Garrity is still sitting in ending inventory. If 60% is sitting in ending inventory, that means that what? That means that they sold the remaining 40%. So now we have our ratio as to how we'll remove that intercompany profit from the cost of goods sold, how we'll remove it from the inventory. And so since there's 100,000 in the cost of goods sold, because they sold 40% of it, that's a $40,000 credit now to Olinto's cost of goods sold. And since 60% of it is still sitting in the inventory, we eliminate 60% of that intercompany profit from the inventory. And so now we've eliminated the entire sale. We eliminated the sale, we eliminated the cost, and we've eliminated that 100,000 profit, some of which was sitting in Olinto's inventory, some was sitting in Olinto's cost of goods sold. Question? Okay. All right, good. Now, this might be a little bit harder. I understand that. But what would you do if you're on the exam and you can't get this part? You would sit there and do what? You'd sit there and you could do the rest of this journal entry pretty easily. And then you might have to just sort of play jazz with this other part. But it's not that bad, really, if you're able to sit there and make that realization and then go ahead and apply those percentages to whatever's left. Maybe the question will tell you that they sold all of it. Well, then you'd eliminate what? You'd eliminate the intercompany profit only from Olinto's cost of goods sold, right? Okay, I do see them do that sometimes. Okay, good. Intercompany bond transactions. Okay, now of course, we have the companies here, the related companies, Garrity and is it Garrity and Olinto again? I don't know. Okay, two related companies buy these bonds, right? Okay, so when you borrow money, you debit cash, you credit the bond payable, and in this case, they said it was a premium. Okay, so they sold the bond for more than face. Now, what happens? On Garrity's books, they're reporting an investment of $275,000 in credit and cash, and presumably, if that bond is held to maturity, when Garrity finally goes ahead and redeems these bonds, buys, gets cash back for these bonds, Garrity will get what? Will get the full $300,000, right? That's the way a premium bond works. Okay, you give up your cash, you go ahead, you sell it, you buy it for more than face. You buy it for more than face. When it matures, you get what? You get the face amount back. So you'll get this 250,000 back. Okay, when the thing finally matures, right? You bought it for more than face, you'll get the 250 back when it matures. Now, what happens? You sit there though, and the next day, you do the consolidation, and what happens? Well, now, in effect, what? On a consolidated basis, you were able to sell bonds, and you only have to pay back what? You only have to pay back the 250, but you got what? You got this 275. And so under this situation now, you got this, 300,000. You only have to pay back 275. So under this situation now, you have gained $25,000 when you look at it as just one big company. It's as though you were able to retire those bonds for what? For 275, when in fact you got what? You got $300,000 cash. If you can do that, that's a gain. Okay. Okay, good. Let's go ahead and let's take a look at intercompany sale of land. And we have this land that we sell between the parties, and we sell the land at a $25,000 gain. Can you sell land to yourself at a gain? No. So what do you have to do? You go ahead and you need to take out that intercompany gain. And when you do that, you eliminate the gain from what you had perceived as the sale. You credit the land at 25,000. So now the land is though that transaction never happened. The land is at 175 and you've eliminated the gain. And that should be the case because again, you can't sell things yourself at a profit. This was one of the problems that I think it was Enron was having, is they were treating entities that were affiliated to them as though they were unaffiliated and not eliminating things that they should have. And it made things look better. You can't start selling stuff to yourself at a gain. So we eliminate that gain, bring the land back down to what it was originally carried at, the 175. Come over. What if it is a depreciable asset? Okay, well, if it is a depreciable asset, what's going to happen is we're going to bring it onto the purchaser's books at a higher cost. Therefore, there'll be what? Not only the gain, like we saw with the land, that has to be eliminated, assuming there was a gain, or if it was a loss, we have to eliminate the loss. But we also have to get rid of the excess depreciation because, again, you don't want to carry it. You're looking at it as one company. You're not looking at it as an arm's length transaction, so you can't bring that up to that higher purchase cost. Okay, so what happens? We go ahead and we have some machinery. Let's read through these. I think it's a little easier to follow it. And sold equipment to Garrity for 100,000. Equipment had a net book value of 70,000. It had originally cost 90. Okay, it had originally cost 90, and I just always cracks me up. You know, I've got a 4,000 square foot house for this bug to fly around in, and it's going to come right to this spot. It can fly anywhere it wants. No, right here. It's going to come right here where I am. Anyway, okay, cost of 90 and accumulated depreciation of 20, so the book value is 70, remaining life of 10 years. Garrett and Olinto prepared the following journal entry on the date of the transaction. So let's go ahead and let's take a look at this. And when we sell it, we debit cash. This is on the purchasers, the seller's books, excuse me. We get rid of the accumulated depreciation. We get rid of the equipment, and we have a gain of 30 because the equipment had a book value of 70. We sold it for 100. On the purchaser's books, of course, we have 100,000 debit machinery, credit cash. And then on the purchaser's books, we take 10,000 of depreciation because they told us it was a they told me it was 100,000, and then we said it had 10-year life remaining, no salvage value, I guess. So that's 10,000 depreciation that we're taking now on the purchaser's books. So what happens? So then we have to basically prepare the eliminating entry for this transaction. So we get rid of the gain. We take that 10,000 out of the machinery count, that account, that now brings it back down to the 90,000, and then we put the accumulated depreciation back at 70,000. Now, what happens? But now we have to sit here and come up with the correct amount of depreciation. So what happens? Well, we had the net book value was 70 at the time of the transaction, and then on the purchaser's books it was 100,000. So they took 10,000 depreciation. Meanwhile, we should have only taken 7,000 depreciation at that original cost. So since it was over 10 years, we debit the accumulated depreciation 3,000, and we credit the depreciation expense for 3,000 because depreciation expense is showing 10,000 when it should only be showing what? When it should only be showing 3,000. So we go ahead, 7,000. So we go ahead and make that $3,000 adjustment. Now what happens? Now we sit here and we say, okay, good. We've got this set. We're showing now the right depreciation expense. We're showing the right amount that needs to get added to the accumulated depreciation. Now, what happens in later years? Okay, well, now we're 1 year later. And now what happens? Well, now we have taken the additional depreciation on the books of the purchaser. And so the purchaser's retained earnings is what is now only not 30,000 too much because of the intercompany gain, but it is now 27,000 too much because we're going to take out the extra depreciation anyway. So the adjustment is not the full 30,000 for that gain. It's what? It's now 27,000 because now we already have the extra depreciation in the purchaser's books. The machinery still has to come down 10,000, but now the accumulated depreciation is not 20,000 off because of the difference between the 90 and the 70,000. It's what? 17,000 off because now we've taken the extra accumulated depreciation on the books of the purchaser. And then of course we still have to adjust the accumulated depreciation for the current year because we continue to take too much depreciation. Okay. Question? Okay, again, these journal entries, yeah.
How long will we be doing this kind of work paper elimination entry for this depreciation adjustment till it becomes 0?
10 years.
10 years.
Yeah, in this example, since we're depreciating over 10 years. After that, then it's simply going to be a credit to machinery for 10 and a debit to accumulated depreciation for 10. Because we would have depreciated more into the accumulated depreciation by $10,000 more at that point. And we would have, and the machinery is, because that's the difference in the original price, there was no salvage value here. Right. And then we would need to, so it becomes a wash because the net is whatever the salvage value is, or 0 in this case. Becomes a wash for the net equipment, but the accumulated depreciation account would be debited for 10, and the machinery account would be credited for 10, and it ends up being a wash. But for 10 years, you're doing this, and this is being adjusted by 3,000 each year as you go along. And over 10 years, right, we would have taken out the full 30,000 out of the retained earnings of the intercompany profit, and we're done at that point.
Right. Thank you, Professor.
Again, I know this probably creates a little bit of anxiety because nobody wakes up in the morning saying, okay, and in the subsequent year, this is what I would do with the depreciation. So notice I'm not having you flashcard a lot of this. This is one of those, we've talked about it. You'll see some questions in the homework. You get familiar with this stuff, and then you do your best to roll with what you might see on the exam. It's not like they're going to give you 52 questions on the second, subsequent year on the eliminating entry. Okay. Okay, let's go ahead, guys, and take a look at a couple questions and see how we do. Some of this might be relevant to our last lecture, I'm not sure, but no, probably not, because we're in a new module, so we should be good. Okay, guys, let's go ahead and take a look at this one. I apologize. I'm trying to put my house on the market, and it's a constant barrage of things. Anyway, so most of us got this correct, and I apologize for giving you as much time as I did with this one. Maybe it's good in a way, though, so that you can kind of see how it could give you something that could waste a lot of time when it should be fairly quick. The answer here is 0, and you look at this and it's 0, choice D, because they sit here and they say to us, okay, I just want to get those results out of the way. They say to us, what should be reported as intercompany receivables? And the answer is nothing. There is no intercompany receivables reported. They get what? They get eliminated. Okay, so they give you this whole journal entry here, just intentionally trying to pull you in to getting all caught up and trying to figure out these numbers when there is no such thing as intercompany receivables reported. They are what? They are eliminated. So here's a question that takes you 30 seconds to answer, but they set it up so that, you know, the way they may present the information to you, they get you all locked in on a journal entry that is that information is not helping you at all. Okay. Okay, good. Let's go ahead and let's try question 2. Okay, I'm going to go ahead and end the poll for this one. And so go ahead and take your best shot. And okay, so we're about 65% here. Okay. You know, I think what happens with some of these consolidation questions, and I alluded to this a little bit last time, remember I mentioned that there used to be the theory exam, and the theory exam was mostly theory, no numbers type of thing. That's why they called it the theory exam. And they tended to ask a lot of questions about consolidation on here to see if you conceptually could keep track of what's going on. And part of what they were doing there is also seeing if they could trick you into making some mistakes, right? By reading question after question that just has words. And so that's a little bit of what's could hurt you in a question like this if you were tired when you were looking at it. Okay, so let's just look here. Perez, the answer is A. Okay, most of us got it right. Perez Inc. owns 80% of Senior Inc. During year one, Perez sold goods with 40% profit to Senior. Senior sold all these goods in year one. Year one consolidated financial statements. I don't know where I got 40%, 80%. Oh, with a 40% gross profit. How should the summarization of Perez and Senior's income statement be adjusted? And we eliminate 100% of the intercompany cost of goods sold and intercompany sales. There is no option in which sales and cost of goods sold would be reduced by 80%. You remove all the sales, you remove all of the cost of goods sold, you remove all of the intercompany profit, right? Remember, any amounts that are attributed to the non-controlling interest are basically going to be a amount that's shown down at the bottom of the income statement as an adjustment to income attributable to the non-controlling interest. So this 80% is not relevant at all for this. Okay, you can show all the sales, all the cost of goods sold, but you have to eliminate all of the intercompany because you can't sell stuff to yourself. Okay. Now, B, sales and cost of goods sold should be reduced by 8. So that's wrong. Net income should be reduced by 80%. No, net income will be adjusted for what? It has nothing to do with it. All of the intercompany stuff gets eliminated. The only thing we do is we take out the portion of income to outsiders that's attributable to what? Attributable to the non-controlling interest. We do back that off of our net income for the period to report the net income of the just the parents portion, or the the portion of the now consolidated company that includes our portion of the subsidiary. I'm assuming we're the parent when I say our. And then no adjustment is necessary is of course wrong. Okay. Okay, good. Let's take a look at number 3 then. Okay, guys, let's go ahead and wrap this one up. I'll give you a couple more seconds. Okay. Okay, good. All right, good. We're at 73%, and that's pretty good for a question like this. This is kind of a hard question in some ways. So let's just go ahead, though, and take a look at what's going on with this situation. Let's read the question first. So answer, most of you got it right, is A, okay? But let's just go ahead and let's take a look. So on January 1st, year 10, Poe Corp purchased a machine for $900,000. On January 10th, Poe Corp sold a machine for $900,000 to Saks Corp, its wholly owned subsidiary. Poe paid $1,100,000 for this machine. That's when they bought it, with an accumulated depreciation of $250,000. Now, hang on a minute. Let's just look at that. So Poe bought the machine. They bought it for $1,100,000 way back when. And that's what should be, I don't know when they bought it. Whenever they bought it, I'm saying way back when, whatever, might have been earlier that year, I don't know. But when they bought it, it was for $1,100,000. Okay. Well, it couldn't have been earlier that year. Maybe it was way back when, because they also tell me that Poe's, put Poe there, I mean their equipment, Poe's equipment. They also told me that the accumulated depreciation was what? $250,000. Now that's what should show on the consolidated financial statements, except we have what? We have one more year of depreciation that we calculated, and we calculated at Poe's original depreciation calculations, which would have been what? 1,100,000 with a salvage value of 100,000 and what? Using straight line depreciated over 20 years. So for this year, okay, because we're looking at December 31st. So for year 10, yeah, there is additional depreciation of a depreciable base of 1 million. I divide that by what? 20 years. So yeah, I do need to take an extra 50,000 of depreciation, right? So from the consolidated company standpoint, I should have debited based on Poe's cost, right? I should have debited the depreciation expense, credited the accumulated depreciation, 50,000. So by December 31st, the equipment account didn't get touched. From the standpoint of the consolidated entity, the equipment account should still show what we paid for this equipment, right? But for the accumulated depreciation, what it was at the beginning of the year, plus the additional 50,000 I should have taken based on Poe's cost and estimated salvage value in life. Question? Okay, good. So let's go ahead and let's just take a nice quick look at the sample consolidated statements, okay? And I think a couple of key things that we looked at before. Remember, guys, that we report the non-controlling interest, so assets, liabilities are reported 100%, and then when we get down to the non-controlling interest portion, we simply do what? We simply add in the non-controlling interest part to come up with my total stockholders' equity, right? Okay, and then when we go to the income statement, okay, we show what? Now again, 100% of all the sales, all the cost of goods sold, all the expenses, 100%, but not 100% of intercompany sales. All intercompany sales get eliminated. Okay, so it's 100% of everything that's sold to outsiders. The stuff that is sold between the subsidiary and the parent, that gets eliminated. Okay, but everything else is 100%. And then we get our net income, and then we back out what? The non-controlling interest share of the net income to come up with the net income that's attributable just to the consolidated entity. And we talked about this last time. I'm just reviewing these examples with you. Okay. Now, when you come down and you look at the sample statement of retained earnings, okay, and notice what in this example, I guess only the dividend that was paid here that's showing is paid. That's the dividend that is paid by the parent. Okay. The subsidiary's dividend, you don't report the portion of dividend from the subsidiary that goes to the parent. It's what the parent pays out as a dividend is shown there. Now, if there was a dividend paid out by the subsidiary, yes, the subsidiary's share of dividend that is reported, that is paid out to the non-controlling interest, that would be a subtract from this column. Remember, this is like the retained earnings of the non-controlling interest. So if there is a dividend that is paid by the subsidiary, we only show as that as a subtract from the non-controlling interest portion of the equity. The dividend that is, supposedly being paid to the parent, that is not reported here. Okay. Okay, good. Let's take a look at consolidated statement of cash flows. Okay, and again, we're really starting to get granular here in terms of what they might ask you, although they could present you with a statement of cash flows, ask you to prepare a statement of cash flows, and maybe ask you to prepare a consolidated statement of cash flows. So if they do something like that, you are going to have to know how to treat certain items for the consolidated statement of cash flows. So let's just go ahead and take a look at a couple of things, okay? And notice here, we say the net cash spent or received in the acquisition is reported in the investing section of the consolidated statement of cash flows. Flashcard that, but let's just look at this example. If the parent company spent $2,500,000 to acquire a subsidiary that had $800,000 cash, we would show a decrease in cash of 1.7, and we show that in the investing section of the statement of cash flows. Okay, so you acquire a company, you pay $2,500,000, but the company had $800,000 in the corporate bank accounts. That's a net amount of cash spent on the acquisition of 1.7 in that example. Okay. All right, good. Come over, and we're just going to sort of flashcard how we do these things. If we get something where they're asking us to prepare a statement of cash flows and it ends up being consolidated, they may give you some additional facts down there, and this is the nature of things that they may give you as additional facts. So that's why I want you to flashcard these and know how to handle these. Okay, so the assets and liabilities of subsidiary on the acquisition date must be added to the parent's assets and liabilities at the beginning of year in order to determine the change in cash due to operating, investing, and financing activities. Again, look at the example. We have the parent's beginning notes payable. We have the acquisition date note payable of the sub, and then we go ahead and do the consolidation. Remember, we're consolidating the income statement, the balance sheet, and now we have a consolidated balance sheet sitting there when we prepare the statement of cash flows. So we would subtract whatever the consolidated notes payable is. That difference then since that balance went down, that would be reported as a cash used, and this would be cash used for operating activity in this case, since I'm assuming this note payable was a short-term note. Okay, now after that and subsequent periods, and I just have a hard time thinking the examiners are going to get you into a second period after the consolidation on this, okay? But in the subsequent period, then you're going to be able to more easily prepare the consolidation, because you would be able to start with the consolidated income statement from the previous year, consolidated balance sheet from the previous year. And then then you're going to prepare the consolidated statement of cash flows, just like you would if it was a standalone entity that wasn't consolidating another entity. Okay, but let's go ahead and think about a few of the considerations that would be a little bit different. Okay, or something we need to keep in mind really when reconcile the consolidated net income to cash provided by operations. And when you do that, make sure you get both that bottom line net income number, include net income attributed to both the parent and the non-controlling interest. Pick that number up before you back out. I misspoke. It's not the bottom line. It's before you back out the non-controlling interest. That's the net income number you're using to reconcile to cash provided by operations. The financing section should report dividends paid to the non-controlling, not to dividends paid to the parent. And again, even on that statement of stockholders' equity, you weren't showing the amount of dividend paid to the parent. It's only that portion, just picture that far out column that I was looking at, that gets subtracted from the non-controlling interest share of the stockholders' equity. And then the investing section may report the acquisition of additional subsidiary shares by the parent if the acquisition was in the open market. Okay. All right. So just go ahead and flashcard those things. And we have a comprehensive example here. I am not going to go through every bit of this comprehensive example with you. I think you should read through it, follow through. They give you all the journal entries, etc. It's basically taking all the transactions we've talked about and tying them into one big consolidation. So you can kind of review the things that we've talked about and look at this on your own. Now, having said that, a couple things that are tricky. What the exam likes to do a lot of times is give you the ending balance of the subsidiary's retained earnings. But remember, for our consolidating entry, we would have to do what? We would have to take off the beginning retained earnings of the subsidiary. So if that's the case, they would have to basically tell you the amount of the subsidiary's dividends, which they did up there. So you'd start with the ending balance. They'd have to tell you the dividends. They'd have to tell you the income. And then that would allow you to get back to the beginning balance of the subsidiary's retained earnings using the base. I guess I'll fill that in. Okay, BASE approach. Okay, so you eliminate the beginning, not the ending retained earnings of the subsidiary. The other thing you're going to have to work with is they may tell you what the amount was that was originally purchased for, and then you're going to have to sit there and do what? Figure out the different components of that. That's not what I wanted to talk to you about, guys. What I wanted to talk to you about is what would be in the investment account, okay? And so you can look at this one on your own. I just want to find, yeah, here we go. With the investment account a year later, that was the entry up there to eliminate the beginning retained earnings, that 300,000, what it was at the time at the date of acquisition. So everything that has to be set up at the date of acquisition, you would do that. And then you start to deal with things that happened during the year. And the point here is that you would have to know how much would have been in the investment account by the year end, because remember, this parent would account for the subsidiary under the equity method. And so there would have been their share of income, which this is 100% subsidiary, their share of the dividends, which is the 100%. So the ending balance would have been 2.7. So you have to know that you need to take off the 2.7, and then you would be able to go ahead and get rid of the entire retained earnings of the subsidiary, which if they gave you the entire amount, retained earnings of the subsidiary, then you wouldn't have to sit there and if they were asking the entry after 1 year, you wouldn't have to go back to the beginning balance to make that journal entry that we saw on the previous page. Okay. All right. Now, as I've said, I'm not going to go through, obviously, this entire worksheet with you. Okay. You can work through that and look through that on your own. They start showing you the intercompany transactions. We went through those. Okay. We went ahead and talked through all of those different things in some of the examples. There's that bond, etc. Okay. So you should have pretty good understanding now to be able to see how we went through and got all these entries, but it is good to look and see how that would have looked, spend a little time, about a half hour or so, just looking at how that would all roll up into the overall consolidation. Okay. All right, good. So with that, let's go ahead and let's see what we can do with this question. I would say this is a pretty tough question, guys, but I want you to try it. I want to see what you do with it. Now, if you got the answer after 1 minute, I'm suspicious. Don't look up the answer and then just put the answer in. Does you no good, does me no good. Who wants more time? Or do you give up? So right now I've only have one person that's picked a choice. Oh no, I got 3 of you, 4 of you, okay.
I am 95% confident, just 95.
You're 95% confident?
Not 95.
Okay, that's good. I'll give you 10 seconds, guys. I know, because this is kind of hard and you're getting close and then I cut you off, right? So I'm gonna give you 10 seconds. 5. Okay, I want to move on because I want us to get into chapter 5 tonight. So, okay, that's, not what we shoot for, 57%, but most of us did get it right, okay? But let's just go ahead and let's work through this one, okay? Now, when you look at this question, what they're trying to trick you into thinking is that somehow the subsidiaries stockholders' equity gets consolidated into the parent. Is that true? No. We eliminate all. What do I want to strike out here? We eliminate all of this, don't we? We get rid of all of the stockholders' equity of the subsidiary because the beginning retained earnings was part of the book value that we purchased. And what? And the ending retained earnings will be rolled up properly in from when we add our net income from the subsidiary to the parent. Okay, so we get rid of all of that. So what happens? There is no way that this is correct. Now I say that, and then you start saying, well, if that's the case, John, then this must be correct. But no, because it asks me what? It asks me the total of stockholders' equity, which includes what? Includes the parent's stockholders' equity, which is 270, plus what? Plus the non-controlling interest part. Right? Isn't that what we saw in the stockholders' equity when we looked a minute ago? It was not just the parents. We also had to add in the non-controlling interest. So my job now is to figure out, well, what is the non-controlling interest portion of the subsidiary stockholders' equity? And remember, we said what? We said that the non-controlling interest portion of the stockholders' equity is like the retained earnings of the non-controlling interest. Okay, so I've gotten rid of two of these. Now, can I manipulate these numbers enough to figure out if it's B or C? Okay, so I'm going to go ahead and I'm going to analyze the non-controlling interest portion of the equity, and I cross this out, and now I have to eat crow and bring it back a little bit, which is what? Ending balance is 51,000. I know that. Okay. Then what? The subtract is going to be the dividends that were paid out to the non-controlling interest people. And I look and what? Well, the subsidiary, Styles a subsidiary, right? Paid 5,000 of cash dividend. Well, if that's the case, 5,000 of cash dividend times what? Times, if it's an 80% subsidiary, my non-controlling interest portion is 20%, right? So that means, yeah, those dividends, on the example I showed you, there was nothing because they assumed, and I think it was 100% subsidiary. So that was why you don't talk about dividends that are paid to the parent, just those that are paid out to the non-controlling interest people. So I would have subtracted 1,000 here, and then I've got to figure out, well, what is the net income that is going to be attributable to the non-controlling interest? So what happens? Well, if I have what? If I have and I have to basically sit here and say, well, if it was 120,000 was the amount that was paid for this subsidiary. Okay, 120,000 divided by what? 80% means that the company is worth 150,000. And what? 20% of that is going to equal what? Going to equal 30,000 here, right? Okay. So if I'm sitting here and I had what? 30,000, and my ending balance now is I have this 30,000. I'm just trying to get the net income that is going to be attributed to the I lost my notes here on my net income number. Where'd my net income number go, John?
I
Okay.
got 20,000 with the 5 and the 36.
Huh?
I said I got 20 with the 5 and 36 from earlier in the year with the 5,000 dividends and the 36 from the beginning of the year. I got 20,000 for net income.
Yeah, but where'd you get 36 from the beginning?
I got 30 from year one was 36. And
Oh, okay. Thank you. My bad. Okay. Thank you. Now I'm back. Okay. Thank you. I'm sorry. So 36 was the beginning, right? Thank you. So 36 is the beginning. Okay. Then what? Then our 20,000 of net income is going, I mean, our net income has to be what? Has to be 20,000. Okay.
yes, that's how I
The
got
subsidiary,
that.
thank you. Okay. If that's for this, I'm putting non-controlling interest over here, and that's what's confusing me. This is the entire subsidiary, right? That's the entire subsidiary. So now I'm sitting there and I don't take off 1,000, I take off what, 5,000, right? Whoever was it was helping me. 56,000 minus 5,000 is 51,000. Okay, that's the entire subsidiary. I'm sorry, that was what was messing me up. That's the entire subsidiary.
Yes.
So now I can go ahead, and with that, what the hell is going on here? And now I can do my calculation for the ending balance in the non-controlling interest. Okay, so for the non-controlling interest, now I've got my 120,000. That's what they paid for the company, divided by what? Divided by 0.80. So 120,000 divided by 0.80 is 150,000. Really? Is my pen going to start doing this to me? 150,000 times what? Times 0.2. That means that the beginning balance now for non-controlling interest is 30,000. And then the net income for the non-controlling interest, because this is the entire subsidiary, 20,000 times what? 0.2, right? For the non-controlling interest gives me 4,000 of net income. And then the dividend was a total of 5,000 times 0.2. That becomes 1,000 dividend that comes out. And at the end, I have what? Ending balance, I have 33,000 if I'm doing my math right on this. So 33,000 becomes the ending balance of the non-controlling interest. So 270,000 for the parent. I knew that was coming over, plus what? 33,000 now for the subsidiary gives me the 303. Okay, sorry about that, guys. I got locked in. I wrote non-controlling interest over the calculations. I mixed my two things up, the subsidiary as a whole versus just the 20% of the non-controlling interest. Question? I know that got a little bit dicey there. You want me to go over it again? Yeah, no? Okay, good. Let's come over then and let's look at this question. Okay, let's go ahead and take a look at this one. And again, notice another question with, I mean, it's got some numbers, but not a lot of numbers in it. Okay, I may have to reboot things because this is real clunky, real sluggish. But anyway, just taking a look here, most of you got it right. Okay, and this is another one of those situations where they just give us words. Okay, so let's just look at this, assuming my computer is going to cooperate. Okay, and on September 1st, year one, Phillips Inc. issued common stock in exchange for 20% of Sago outstanding stock. On July 1st, year three, Phillips issued common stock for an additional 75%. And this really was something we talked about last time. You only take your portion of the net income from the period that you acquired the subsidiary forward. So you don't take 100% if you only bought them. Remember, I said if you bought them in July, you only take half of the year's net income. Okay, so it would be what? It would be 20% up to June 30th, because then they continue on and they buy that extra 75% in July. And so it would be 95% from July 1st to the end of the year. Okay. Okay, good. Let's look at number 3. And this one's kind of tricky too, but maybe that's good. Okay, guys, let's go ahead and look at this one. And about half of us took a shot at it, but everyone who did got it right. So that's good. Okay. But the reason this one gets a little bit on the tricky side. Okay. And you take a look and they tell us that they paid this amount for 75%, et cetera, et cetera. And then they tell me that the dividends that were paid out by the parent were 15,000. Okay, so I picked up that 15,000, and in the in the column for the parent, right, in the stockholders' equity, they'll show dividends that the parent paid out of 15, right? Now you look and you say, okay, John, but there is this 25% non-controlling interest. And in the non-controlling interest column on the consolidated, we would be showing dividends that got paid out to non-controlling interest. And so you sit here and you look and you say, well, dividends paid were 8,000. And if dividends paid were 8,000 and I take 25% of that, well, that's what? That's 2,000. So yeah, when I get to the consolidated column there, I should show what? I should show 17,000, but they don't give me 17,000 as a choice. So that means that what? Yeah, that 15,000 would be reported, and I don't have the option of coming up with this 17,000 so that they could show the 2,000 and the 15,000. So I'm sitting here and say, well, then there would at least be the 15,000 because they're not giving me a choice of 17,000. Okay. Okay, good. Come over and let's talk about goodwill method. I mean, not goodwill method, but goodwill impairment. Okay. So what's going on? We're sitting here and we're remembering that we only report acquisition goodwill. Remember, guys, that goodwill that comes in through the equity method, just remember, is not reported. Okay, we're not going to report that on the anywhere. Acquisition method, yes. And remember, we use the full goodwill method for US GAAP. For the equity method, we use the sort of the partial goodwill method, and then there's really no difference between the two if you're sitting there and acquiring 100%, right? We talked about all that. Now, what they may try to trick you on is you acquire the goodwill and you're going to report the goodwill on the consolidated financial statements. And then they're going to say that during the year after the acquisition, they started paying all this money for advertising to increase the goodwill. That is all expensed. Okay. So again, once you have consolidated and purchased the company, you don't make goodwill gooder. You just report what you acquired as goodwill. It is not amortized, but it is evaluated for impairment, which is what we're talking about here. Okay. And when we evaluate goodwill for impairment under US GAAP, we calculate that at the reporting unit level. Okay. Now, when you look at, and what we're going to look at here in a minute, you consider both qualitative, but you also consider quantitative evaluation of goodwill. Okay. Is there something that isn't necessarily reflected in the numbers that is going to impair the goodwill of the entity? And you'd have to think about that. So it's not just a quantitative analysis, qualitative, I flip what I'm highlighting here. It's not just qualitative, it's also what? Quantitative. Okay. Now, when you look at it quantitative, okay, then you're going to, the evaluation of goodwill impairment involves comparing the carrying value, again, of the reporting unit. It's at the reporting unit level, including goodwill, to the fair value of the reporting unit, without goodwill, to the fair value of the reporting unit, including goodwill. The carrying value, boy, we're starting to struggle here. Carrying value, okay, versus the fair value, okay, including the goodwill, okay. If the fair value exceeds the carrying value, there is no impairment, you stop, okay. If the fair value is less than the carrying value, there will be impairment charge equal to the difference between the fair value and the carrying value, okay? And the impairment charge is cannot exceed the value of the goodwill that is allocated to that impairment, to that reporting unit. So let's just go to the example because I'm having trouble reading that, okay? And I think you'll understand it better in the example. So Omega Inc. has 2 reporting units, Alpha and Beta, which have book values including goodwill of 500 and 675 respectively. Alpha showed goodwill of 50, Beta shows goodwill of 75. As part of the company's annual review of goodwill impairment, Omega determined that the fair values, including goodwill of Alpha, are 480. Okay, and I'm getting nervous here with Alpha because what they told me that it was 500 is a carrying value. It's got a market value of 480. So I know I'm gonna have to do something with the impairment there. But with Beta has a carrying value of 675 when the market is 700,000. So I'm done. I do not have to calculate any impairment for Beta. I do these at the reporting unit level. I'm done with Beta. I don't have to do anything more with Beta. Okay. Now with Alpha, I'm going to have to continue on because Alpha, again, their fair value is less than the book value. So what happens? Well, I need to bring it down to that lower fair value, and the difference is what is 20,000. Okay, so what do? I attribute that entire 20,000 to the goodwill. So I debit loss due to impairment of 20, and I credit the goodwill for 20 because I'm saying, hey, that drop in the fair market value is due to deterioration of the goodwill, and I take that out of the goodwill. Okay, and then I would basically stop at that 50,000. If it falls down any more difference, I do not have any more goodwill left. I would have written off all the goodwill, and there can be no more impairment for the goodwill. Okay. Okay, good. Now, if it's IFRS, then I'm going to change up the consideration a little bit, and I'm going to look at the cash generating unit level. Okay, so the goodwill is impaired if the carrying value of the cash generating unit is compared with the cash generating units recoverable amount, which is the greater of the CGU's fair value less cost to sell and its value in use, whichever of those is the greater. And then you take a look, and an impairment loss is recognized to the extent that the carrying value exceeds the recoverable amount. Okay, and so let's just go ahead and look at a couple of questions. And what I'm going to do is do question 2 with you. This is IFRS. Again, IFRS is not tested after July 1st, but it's worthwhile for us to look to see what they were talking about here. So I've got what? I've got this fair value and carrying value, okay? And then they tell me the entity estimated that if it were to sell the cash generating unit, it would incur cost of $250. The entities also determined that the present value of the future cash flows expected from the cash generating unit is 2.4. Cash generating unit reports goodwill of 65. So what would be the impairment loss here? So what happens? Well, first, I've got to figure out what's greater, the fair value or the present value of the future cash flows. So I go ahead and I subtract that 250,000 costs that they would incur to sell. And when I subtract that 250,000, now I get 2,350,000. So I'm looking at that and I'm saying, okay, which one's greater, 2.4 or 2,350,000? And I determine what? that 2.4 is greater, right? So it's either the present value of the cash that's going to be generated or the cost, the fair value less cost to dispose. And then I look at what it's being carried at. It's being carried at 2,425,000. And so I go ahead and I make that comparison, and I've got what? I've got a $25,000 impairment. Okay. Okay, good. Let's do question 1, and then we're going to take a break and jump into chapter 5. Okay, guys, most of us who tried this one got it right, okay? And so the answer here is C, but let's go ahead and take a couple seconds to look at it. Okay, so the answer here is C. And they tell me, and there's only one reporting unit here, right? So we have 3 million that they're talking about anyway. We had a $3,450,000 reporting units book value. Okay, that's the book value, and then it has goodwill of 225,000. As part of its annual review of goodwill impairment, the entity determined that the fair value of the reporting unit, including goodwill, is what? 3,310,000. So if that's the case, I have what? I have impairment. I have impairment of what? 140,000. Okay, so to bring it down, I'm going to do what? Debit the impairment loss. $140,000. And credit what? Credit the goodwill. Some of you picked B, and I think it was because you were taking the difference off of the goodwill and then showing me what the resulting balance would be in the goodwill account after you take it off, which is correct. It would be, I guess, 85,000 after I take the 225 minus this 140. Yeah, that difference is 85. That's not what they asked. They asked what the goodwill impairment loss will be, not what is the resulting goodwill amount. Okay. All right, good. That wraps up chapter 5 here. I mean 4. I wish we were done with chapter 5, not quite. Okay, so what we're going to do is take a quick break now, and we will come back after the break and pick up chapter 5. Okay, and the goal is to get hopefully up to the bond payable section here before we have to call it an evening. Okay, but let's go ahead and let's take 10 minutes. We'll come back. We'll make it, we'll come back at 1:45. Okay. Okay, guys, let's go ahead and jump back in. I want to see if we can knock out at least these first 3 modules here before we have to end tonight, which will give us a good shot of getting through chapter 5 by next time. Okay, so let's just go ahead and take a look at some potential point values. There'll be a general discussion of how to handle accrued liabilities, 2 to 3 points. I mean, some very basic things that almost are introductory to accounting type of issues with just a little bit of a nuance as to how you'll handle some of these things, and we'll review that. Contingencies, very straightforward stuff. The examiners don't spend a lot of time with that. Couple of points, okay? Where we are going to spend most of our time, and I'm anticipating we'll really get to this next time, is going to be when we talk about long-term liability, and they really mean bond payable, okay? And bond payable has long been an area on the exam where you can expect a bunch of multiple choice questions and or a task-based simulation. And then we'll finish up with kind of a lighter area dealing with troubled debt restructuring. And that's about 2 points, just a light coverage there on the exam. Okay. Okay, good. So let's see if we can get through at least this first couple modules. And we start talking about how to handle our payables and accrued liabilities. And we just start out saying that liabilities are going to be either current or non-current. Now they tell us that a current liability, okay, current liabilities are those that will be have to be paid within the next year or the operating cycle, whichever is longer. And if you're not a current liability, you are what? You're not. You are a non-current liability. Now, a current, but by operating cycle, operating cycle, not operating cycle. We're basically talking about the time to convert an entity's service or inventory into cash. Well, if you're a sushi restaurant, then you're obviously going to do what? Convert your inventory into cash in days, I hope. Otherwise, don't eat at that sushi restaurant if it's taking them longer than a few days to convert their inventory into cash. So their current liabilities would be those that would be consumed within a year. If we're talking about a winery, well, their inventory is what? Is grapes, wine sitting in a container of some sort. And so they might have what? They might have a 2-year period before they turn their inventory into cash. So their current assets would be those that would be used up and say or be paid off, and it would work the same for assets, be paid off in a period of a longer than 1 year period. So it's 1 year or the operating cycle, whichever is longer. Okay. Now, when we look at our accounts receivable, our accounts payable, we could set those up using the gross method, which means we'll take them not assuming that we're going to take any kind of discount, or the net method. Basically, I will record things net of any anticipated discounts. Okay. Now you come over and they show you what happens if you set something up under the gross method, okay, which you're just going to set up the entire liability. If you use the net method, then you would go ahead and set that up net of any discount. Now, it's worth noting here that when you pay that, regardless if you pay it using the net method or the gross method here, when you pay it, then here they took the discount, and notice the discount, and the discount reduces inventory. Now they sit here and they say if the perpetual method is used, and the credit would be to inventory, but I don't care. Even if you are using a purchases account, what happens? If you reduce the purchases, what's going to happen? Well, then my goods available for sale will go up. My goods available for sale goes up. I subtract off my ending inventory, my cost of goods sold will be affected. So eventually, any amounts that you have as purchase discounts that end up getting reported on the financial statement, you don't report the purchase account on the financial statement. So what happens? That difference ultimately reduces inventory. So just remember that whether you're using perpetual or periodic, any discount on the inventory reduces the inventory account on the balance sheet. Okay. All right, good. Now you come over and you take a look at your trade notes payable, and I'm not going to go through that. That gets to some stuff that we will look at here again in a little while, and I don't want to be redundant with our time. So don't worry about that example up here. Come over and let's look at current portions of long-term debt. Okay, and debt instruments may be set up such that periodic principal payments are made during the life. In this case, the principal due within the next year should be treated as a current liability. Okay, now flashcard that. And basically what we're saying to you there is, look, let's say you have a 5-year note and you have to pay $100,000 per year on that. And you've got that first $100,000 payment coming up. Well, that $100,000, which is going to be due, say, January 1st the next year, that portion of that total $500,000 would be listed as a current liability, with the remaining 4 in that little example being considered non-current. Okay. Now, this gets a little bit, I don't know why everyone's so interested in this. I see this talked about quite a bit in literature about different things, and I'm just always wondering, why is everyone always talking about this? But it is here, and we are going to go ahead and flashcard the rules. So what happens? I have a debt, and I've been carrying that debt, and now the debt's going to come due next year. And I sit there and I say, well, I'm going to refinance this debt, and I'm going to refinance it on a long-term basis. So even though the debt's coming due next year, I'm going to refinance it for 5 years. Okay, so is that debt considered current or non-current? Okay, so let's take a look. Under US GAAP, a short-term obligation may be excluded from current liabilities and included in the non-current if the company intends to refinance it and the intent is supported by, okay, and let's just go ahead and flashcard the support we need here. You could put that yellow part on the front of the flashcard and then say, what is the evidence that would allow us to take what we think would be current and put in the non-current, because I'm going to refinance it on a long-term basis. Okay, so if you had actually refinanced prior to the issue of the financial statements. So what happens? I don't execute the refinance until my year end is December 31st. I don't execute the refinance until January 1st of the next year, but I don't issue my financial statements until February. I can carry that as non-current because what? Even though at the balance sheet date I hadn't executed the refinance, I did before I issued the financial statements. Okay. Or there is the existence of a non-cancelable financing agreement from a lender having the financial resources to accomplish the refinancing. You've gone to a reputable bank, but they don't say it here, but this would have to be done by the BS date. Okay, for example, let's say my balance sheet date is 12/31/2021. That non-cancelable financing agreement has to be in place by the balance sheet date. Okay, and then presumably, I guess I would go ahead and execute that sometime in that next year or whatever, but I have to have that in place by the balance sheet date. Okay. Okay, good. And you can sort of see the journal entry, and it is a simple reclass where you're taking something out of the short-term liability and put it into long-term if you've met that criteria up there. Okay, good. Come over and let's just take a look at the accrued salaries and accrued salaries, and those are those that haven't been paid, obviously at the balance sheet date. Okay, so come over, and I'm not going to go through, the journal entry to accrue salaries. We're going to look at another example in a second that I might look at you with, but you debit the salary expense, you credit. Oh, actually, this is something worthwhile here. Okay, let's look at it. Notice that when they accrue the wages payable, okay, they go ahead and they accrue it, and then, well, no, that's really too easy for you, but let's do it anyway. Okay, they set up the wages expense, they credit the payable, and then when they pay, they go ahead and what? They pay the amount that was outstanding at 12/31, but since they're going to pay the person for, say, the full 5-day week, of course, the portion, the 2 days that fall into the new year or the new accounting period, that would be expensed, and you would debit the payable and you pay the person their full cash. If you're ever dealing with wages, accrued salaries, guys, just pretend like it's your money. Pretend like you're working for somebody and they owe you money, and you'll be able to figure this out very well. This is what you owe me. That's the liability, and this is the expense because the work was done in that next accounting period. Okay. So what I really wanted to talk about here was the property taxes payable. And we're going to talk about taxes payable in general. And they tell us that you have 2 choices on property taxes. So let's just flashcard this, okay? With the property taxes, it may be accrued prior to the receipt of the tax invoice, and then you're going to go ahead and do your best to estimate what that amount will be and allocate it to the period to which it relates, okay? Or they do allow you to go ahead and wait until you get billed, and then you can go ahead and record that property tax expense in the period in which you get billed. The reason they're willing to do both of those is that property taxes don't fluctuate wildly from period to period. So it really doesn't hurt to wait until you can see the bill, book the expense in the period that you get billed, even though the billing may be for a period that has passed or a period that's coming. But because you don't have wild fluctuation in property taxes, FASB looked at that and said, you could just wait to be billed and just take it in the period you get billed. Okay. So you'd have to read the question to see what they're saying to you in terms of how they book their property taxes. Okay. Sales taxes payable. Okay. So what happens here? Hey, if you're collecting taxes on behalf of the state, usually is the one that you're collecting those taxes for, you're a store. Some of you may want to look into working for the state Board of Equalization. Okay, they do recruit at Golden Gate, and what they do is they look to see that the government is going to be getting the proper sales tax based on an entity's sale. And what's kind of cool about working for them, I've heard some presentations at recruiting events and stuff from them. You could one day be working on a mom and pop store to see how they're, collecting and remitting taxes over the state. Or you could end up looking at Apple and seeing how they're dealing with the property taxes and how they're being, sales tax, and seeing how they're being remitted to the state. And so it's kind of an interesting opportunity. You might learn a lot about the operations and the revenue part of operations about a lot of entities. But note that the revenue that we record is obviously a net of the taxes part that we collected.
I have a question.
Yeah.
Does the government discriminate based on age?
Nobody better discriminate based on age, or the government will want to talk to them.
Right.
They shouldn't. They're not supposed to.
Yeah, we
mean,
know that.
I think anywhere you go, there's always going to be biases from folks. I mean, that's just the law is the legal answer is they better not. Okay, but as your mentor, my answer to you is, hey, there's biases everywhere, right? And so it's your job to make sure that they understand the value that you bring to the table. And if they are doing their job correctly, it should not make any difference at all, okay? Once you show the value that you bring to the table. How's that for not answering your question?
That's good, thank you.
Yeah.
Very good.
I would encourage you, as you move along, and then I'm going to stop. I had a former student that was talking to me, and she is getting her CPA. She's got her paperwork in for the CPA. She's just waiting for the board to issue her license. And so she talked to me about the different things that she might be doing at this time, and I got a little annoyed because she kept underselling herself. Well, I think I should go for, there was some junior kind of position. I'm like, okay, what you need to do is you need to walk in and get the best position you can. You've been working for she had been working for a big four firm. You've got your license, you passed the CPA exam. I mean, you should be walking in there trying to find a controller position or something like that. All they can tell you is no, okay? And so I would suggest that you look to where you see yourself and then you push for that. And you don't take some assholes and that might be discriminating based on age or whatever answer of no. That's my speech for today. Okay, and you do that, and one day you look up and you're saying, how am I possibly running this whole operation here? So, okay, all right, enough of that. But no, they shouldn't. Payroll, guys, okay, I'm not going to get into payroll accounting here. I think it is pretty obvious, that you have your expense, the cash is the amount that goes to the employees, and then you have your withholding from the employees that is a liability. And then, of course, you have your portion, if you're the employer, of the payroll taxes. And then, of course, you have to also remit that over to, the unemployment or the, Social Security and all that, FICA. Okay. All right. Bonuses. This stuff, guys, is so straightforward that that's why I'm not spending a lot of time with it. And I think you'll see in a lot of the problems, it's just that case. They want to see if you know that payroll tax is a liability. Obviously it is. Now, bonuses are kind of fun. And I don't know about you, but I have fun when I have to set up basically an algebra consideration. Okay, it allows me to sort of just get a little bit out of my debit and credit mode all the time and allows me to kind of think a little bit more analytically, okay, as we go through this stuff. So this is pretty fun, I think, okay? And it's really fun when you get the right answer on a question like this. So let's just look at what's happening with the bonus here, okay? So X Corp offers its sales vice president bonus equal to 10% of net income after deducting taxes, but before deducting the bonus. Income without taxes, or the bonus is 100,000 and the tax rate is 40%. So we have a problem because how do we know what the net income is unless we know what the bonus is, but we don't know what the bonus is unless we know what the net income is, right? So we sit here and we say, well, look, the bonus is equal to 10% times the $100,000 before taxes minus whatever the taxes are, because taxes are part of the calculation of the net income. The taxes are what? Are 40% of the 100,000 before but we have to subtract the bonus to figure out what the taxes are, because the bonus is deductible for tax purposes. Okay. But what I've done is I have just because I had two unknowns, now I've created two equations. And so now I can go ahead and work this question, right? And so what happens? Well, now I say that the bonus is 10% of 100,000 minus what? 40% of 100,000 minus the bonus. So now I just got to solve for what? For the bonus, right? So I go ahead and bonus then equals 10% of 100,000 minus 40% of 100,000 minus the bonus, right? Because I get to deduct the bonus for determining my taxes. And so then I go ahead and take the bonus is 10% times 100,000 minus 40 plus 40% of the bonus, just applying that 40%, right, to everything inside the parentheses. Then I go ahead and I do what? I apply 10% to everything in the parentheses. 100,000 minus 40 is 60,000. 10% of that is 6,000. And 10% of 40% is 4%. So now I just go ahead and I subtract 4% of B from each side. So 96% of B equals 6,000. And then I simply divide each side by 96%. The bonus is 6,250. Okay. So, I mean, this is the hard part right here, is just sort of getting your head to kind of wrap around the abstract here a little bit, but it's not that bad. And for accountants, it gives us a chance to sort of, use the other part of our brain to figure out what's going on here with this stuff. Then again, maybe only accountants think about this stuff for fun. I don't know. Okay. I had a friend one time, they were talking about that it was the 40th anniversary of a team, I think the A's or something like that. And I told my friend, well, actually this year it's the 41st anniversary, because the 40th anniversary would have been last year. They should have counted last year as the 40th season. He's like, John, only you would mention something like that. Don't worry about it, okay? Not everything's an accounting equation. So anyway, okay, come over and let's take a look at compensated absences, and let's take a look at liability recognition, okay? Now, the compensated absences is a fancy way of talking about sick leave and vacation, okay? Now, the rules are going to be applied evenly to both sick leave and vacation, but we're going to see that they're going to require that we can reasonably estimate the amount of a compensated absence is one of the rules we're going to highlight in flashcard here. And because of that, it gets more difficult to estimate what the sick leave is going to be. I mean, we've all learned that health is not given, and over the last year plus, right? So what happens? We start to take a look at this, and right when I said that, my arm started hurting because I got my first shot today. I'm supposed to get the next shot. I went in there and I was like, can I have the Johnson & Johnson, please? So I don't have to come back. We don't have it. So they gave me the Moderna, and then you got to go and get the next round. The only thing is my arm hurts. I don't have any other side effects. So when it's your turn, go get your shot, guys. If you haven't already, when it's your turn, I know you got to be old to do it, and you're young at this point. And when the time comes, go ahead and get your shot and make yourself proud. Okay, don't worry about it. Okay, all right, good. Now, enough of that. What happens? So because health is not given, it is difficult often for a company to predict the sick leave. So they tell us here hey, companies often do not accrue for sick leave because what? They don't know whether or not their employees are actually going to take that. Okay. So let's just take a look. Compensated absences or paid absences, usually vacation, holidays, sick pay. Okay. And liabilities relate to future absences and are accrued in the year ended if all of the following are met. When you get something like that, I feel a flashcard coming. Okay. The employer's obligation to compensate for future absences is attributed to service already rendered, right? For every year you work, you get 2 weeks vacation, right? You've already worked that year. The obligation relates to the rights that vest. Okay, that means your actual vest means you're going to get to keep it, right? You actually have it. Payment of compensation is probable, and the amount can reasonably be estimated. And if all three of the conditions are not met, then you're simply going to have to put a footnote. So include that on the flashcard. So when you look at that, they tell us, well, look, sick pay is kind of weird because an employer is not required to accrue sick leave. Estimated future sick pay is not reliable, and so therefore many companies do not accrue sick leave, but you could. So they don't come down and require you to do the sick leave. Now, if they said something like, the employee, if after they work for 5 years, then get to keep their sick leave, okay? Then what? Then at that 5-year mark, then yeah, they would have the liability or something like that if it actually vests. And sometimes companies will do that to maintain you. Sometimes they'll say, well, if you don't take any sick leave, we'll add something to your pension or something when you retire. So again, if it vests that way, then yeah, take the liability. But for most of the time in the CPA exam, if they're talking about sick leave, look to see that they're talking about some sort of vesting and their ability to estimate it in order for you to be able to take it as a liability. Okay. Okay, good. Now, this one is kind of interesting, and I was getting that earlier example a little bit mixed up with this one. And that when you accrue, say, vacation, I'm not trying to strike that out. When you accrue the vacation, you accrue it at the prevailing wage. Debit the wage expense, credit the payable for whatever they're making at that time. Now, by the time they get around to taking this leave, say in the next year, maybe they've got a little bump up in their salary. If that's the case, then what? You pay them out at their current salary. Look, the dude's not going to take vacation and say, yeah, pay me what I was making 2 years ago when I earned this. They want to get paid what they're making now. So you pay them out for their vacation when they're taking it for what they're making at the time they take the vacation. You debit the liability for the vacation that you set up at the wage when they earned it. That difference is an expense of the current period. Okay, so even though they earned that in an earlier period and you set up the liability for that, when you pay them, any difference between what the rate that you're paying them and what you accrued is going to be debited to wage expense. And sometimes students will say, well, what if they got a cut in pay? Okay, well, then you would get to credit wage expense, change in accounting estimate. We handle it in the period of change and prospectively. So you don't have to go back and say, well, wait a minute, my liability wasn't that because I didn't know I was going to cut this dude's pay. It doesn't work that way. Okay, you just go forward with that new estimate. Okay, okay, good. IFRS says you got to accrue sick leave. Okay, so again, we haven't spent a lot of time comparing IFRS to US GAAP, but won't hurt to flashcard that if you want to. Okay, all right, good. A lot of straightforward stuff here, guys, but let's talk about exit or disposal activities. So what happens here? Let's say I'm renting a building from you, okay? And the building is, I don't know, I rent an office space 20 by 20. And then my business is doing so well that I say to you, I really would like to Let's go the other way. Let's say I'm renting a building, office space from you, a big office space from you, and then I realize my business doesn't need that much space. So I come back to you and I say, I really would like to get a smaller space. Can we basically end the rental agreement at this point and start up a new one for a smaller space? And you look at me and you show me the contract and you say, well, looky here, there is a cost to get you out of this rental agreement that I'm going to make you pay off for me. Okay. So if that's the case, then I'm going to have to go ahead and recognize a liability and an expense for having to pay to get out of this current rental agreement because you're not going to let me out unless I pay that. Okay. So let's just take a look and see what the criteria are in a situation like that. And well, these are examples. Costs associated with exit activities include involuntary employee termination benefits. If I let my employees go, I got to pay them an amount to terminate them. Cost to terminate a contract that is not a capital lease. We're going to talk about capital leases next time. But again, I'm talking about, say, a 1-year rental agreement. It doesn't meet the criteria of a capital lease. I want to get out of it. You're going to make me pay to cancel that contract, okay? Or other costs associated with cost to say consolidate. I'm going to shut down one part of the business and I don't need the accounting team from that part. And again, I got to pay to terminate those guys, etc. Now, sorry guys, I don't want the flashcard there. I want it here. Let's move that flashcard down. Okay, so let's see what the criteria is for liability recognition. An obligating event has occurred. I'm trying to get out of that rental agreement. The event results in a present obligation to transfer asset. Okay, transfer asset. Let's not get too fancy. The asset that is going to be transferred is what? Cash, probably, to get out of, say, this rental agreement. And the entity has little or no discretion to avoid it. Hey, the the guy that's renting me the property, and that's why I said I wanted to go from a larger to a smaller, is saying, well, wait a minute, dude. I had 50 people lined up to buy to rent this. I gave it to you. Now those 50 people are gone, and you want to get into a situation where you're paying me less rent. No, you're going to, for a smaller space, no, you're going to have to pay up that. So I'm going to say, okay, well, what do I want to do? I want to get out of this deal. So I'm going to have to pay it. I don't really have any ability to avoid that. Okay. Now, how will I recognize then? Okay. How will I recognize then the liability, the income statement presentation for that? Okay. And if I'm doing this, costs associated with an exit disposal related to discontinued operations will be part of my discontinued operations, part of my income statement, right? If it is what? Costs associated with continuing operations is part of continuing operations. So if I'm having to pay these exit costs because I'm shutting down a division, that's part of what? That's part of my cost of shutting down. It would probably be part of my cost of disposal, part of our lid. Remember, loss, impairment, disposal, gain or loss. That would probably be part of my disposal loss in the discontinued operation section if it was associated with a discontinued operation. Flashcard that, and then disclose all of the following. Flashcard those. Make sure that you don't already have a flashcard for those guys. I'm not going to read through them because it's disclosure requirements, and I think you can figure that out. But do flashcard disclosure requirements. If you don't find it in your actual set of flashcards that are pre-made for you by Becker, then add one. There's nothing more annoying than getting on the CPA exam and all they're asking you is what needs to be disclosed, and you're missing that question because you didn't do a good job to make a flashcard and memorize a list of very simple requirements as to what needs to be disclosed. Okay. Okay, good. Asset retirement obligation. What happens here? Well, let's say I'm a coal company and I'm mining coal. And when I mine coal, I do what? I put a big hole in the ground and I pull coal out of the ground. Okay, now what happens? The federal government comes down and says, well, you can't leave that hole there. And so they'll tell me I got to clean it up. Okay, so FASB comes along and says, well, if you have an obligation to clean up that mess after you're done pulling all the coal out of the ground, we're going to make you recognize a liability for that future amount that you're going to have to pay out when you're done pulling the coal out of the ground or whatever. So we're going to have to set up a liability. We will also, though, be allowed to set up an asset at the same time. And what they allow us to do is depreciate that asset and amortize that liability at the same time to help a little bit with the smoothing of the expense associated with that cleanup cost that's coming. If they made me debit expense as soon as I estimate the amount of the liability, which maybe won't happen for 10 years, that would be a little unfair because all of a sudden I've got this huge expense hitting my financial statements. So that's why they let me set up the asset. I take what? I take a certain amount of expense for the accrual of the liability and I depreciate the asset. Okay, so let's go ahead and let's just take a look with that as a visual when they tell us, hey, you know, it's the mining industry that deals with this a lot. So if we're in West Virginia somewhere, you know, somebody might say, yeah, I was involved in the mining industry. Okay, so we're talking about that. Okay, now we take a balance sheet approach. Okay, and in this balance sheet approach, we will go ahead and set up our liability. We have little or no discretion to avoid, and an obligating event has occurred. I'm pulling the coal out of the ground to get whatever, right? Okay, good. So let's just take a look. Okay, when an asset retirement obligation exists that qualifies for recognition, an entity records an asset and a liability on the balance sheet equal to the fair value of the asset retirement obligation. Okay, so go ahead and flashcard that. Asset and liability get set up for the fair value of the asset retirement obligation. If a reasonable estimate of fair value cannot be made, the liability and related assets are recognized when a reasonable estimate can be made. Okay, so you can flashcard that. Just a couple of just, you know, rule-based type of things. Now let's go ahead and let's take a look at how we'll calculate this asset retirement obligation liability. So you come over to the next page. Okay, and let's take a look at the asset retirement obligation, and we will debit asset retirement obligation cost, an asset, and we will credit the liability. Okay, now what will happen? We will have subsequent measurement, and we'll take accretion and we'll take depreciation. Okay, and so we will basically take into expense over time the amount that we set up for that liability as we're pulling the coal out of the ground or whatever it is. We'll figure out that we're getting closer to the day when we're going to have to clean this thing up. And so we'll take expense year by year as we get closer to the day when we're finally going to have to make the cleanup, right? Then what happens? We will also depreciate the asset at the same time that we set up by debiting expense and crediting the accumulated depreciation. Okay. Now you look at all that and you're kind of like, okay, what the heck are we talking about here, right? And so I think it's worthwhile to spend a little time with this example, and I think you'll start to get sort of what's going on here. Okay. So we've got this mining enterprise purchased an existing coal mine. Brown expects to operate the mine for 4 years, after which it is legally required to dismantle the mine. Brown estimates it will pay $500,000 to dismantle the mine. Brown uses straight line depreciation and accretion rate of 10%. The present value of $1 for 4 periods at 10% is 0.68301. Now, let's stop for a second. Okay. And let's practice with the present value table. Please don't log me out. I bet you it's going to make me log back in. No, thank God. Okay. Yay. It did make me log back in because I had promised I would put the present value tables up and then I forgot to. Okay. But there they are. Okay. So the present value table is there. Open, please. Okay. No, I already had it open. No. Okay. So I think I already had it open. That's okay. All right. So let's take a look. And because that amount is a one-time payment, I go to the present value of $1 table. Somebody remind me, I know it was 10%, but what was the period? 5 years?
4.
4, thank you. Okay, but regardless, there's the number, well, not regardless, on the 4-year row, 10%, it's 0.68301. Okay, so I use that present value of $1 because it's one-time payment. Notice all the amounts are less than 1 on this table. So now I come over back to my problem now. And is that the factor that they used? Where's my factor? 0.68301, right? Okay, good. All right, so that's the correct factor. They multiply that out. Okay, and that gives me the present value of that 500,000, and the present value of that 500,000 then ends up being 341,505. I debit the asset, I credit the liability, and these two will never speak to each other again. They now go on 2 separate journeys as to how they get amortized for the accretion expense and how they get depreciated for the depreciation expense. Okay, so my accretion expense is going to be 10% of that amount that I set up for the first year anyway. That's 34,150, and my depreciation expense is going to be the 34,100, the present value of the 500,000, 341,505 divided by 4. And so I debit accretion expense, I credit the asset retirement obligation, 34,101, and I debit what? I debit the depreciation expense and I credit the accumulated depreciation. And I just keep going like that. So the liability is growing, and eventually at the end of the 4 years, how much is going to be in that account? 500,000. I finally will be to the future value, right? Because I set that up at present value. Okay, so I go ahead and I have my asset retirement costs, the asset, which is the 341 minus the amount that's depreciated. The asset retirement obligation, they're going in opposite directions and not at the same rate, are they? Is going to be the accretion expense plus the beginning balance. And that keeps on year after year now, okay? And you can see that I keep adding, and then I'll multiply that next, after I add that on, right? Then I'll multiply that by 10%, add that on, multiply that by 10%, and so on, right? Whereas the asset is depreciating on a straight line basis. So eventually I will do what? This will come up to 500,000. Now that was an estimate of what I thought the cost was going to be to clean this thing up when I'm done. The actual amount will likely be different, hopefully not substantially different, okay? But the difference then would just go to the cash, and whatever it is that I actually pay at the end of the 4th year, the difference between my liability and what I actually pay is an expense, okay? Now, what I don't understand from the federal government standpoint is I'm wondering how good of a job they do in helping companies to estimate what the cleanup cost is going to be. Because if the government came down at the end of this thing and looked at the mess, the hole in the ground, and said, hey, you got to pay $5 million to fix this. Well, now you've got a company that has been expecting a liability in the neighborhood of 500,000, and then all of a sudden you sock them with this huge bill at the end. So my recommendation to the Office of Surface Mining would be 2. 1, do a good job figuring out what the cost is going to be to clean this thing up at the end, so that the company knows going in and they're doing the proper accounting and the proper financial management to have the money they need. And then I would require them, what the federal government should do is require them to fund this thing by putting the increase in liability into an escrow account each year, so that when they get to the end, there is the money to pay this off. And I say all that because I was on an assignment where the federal government was doing a horrible job collecting penalties for inappropriate cleanup by mining companies. And they kept telling us, well, we'll chase these bad guys out of the business eventually, so don't worry about it. If they don't pay us, we don't let them mine anymore. But the problem is that the company can dissolve the old corporation, emerge as a new corporation, and get a new mining license, and leave this mess and these uncollected penalties behind. And the Office of Surface Mining is unable to pierce that new corporate veil to get that money, or prevent them from getting a new license. So anyway, that's the end of that story. Any question? Okay. All right, good. Let's take a look at this one then. And make sure and read these very carefully, guys. I think what makes questions like this seem kind of hard is that if you don't read them carefully, you start making mistakes. They should be avoided because the material, it's not that hard. But if you get twisted up in the reading, and you don't read it carefully, you could make some mistakes, which is obvious. I'm not sure what I'm trying to say. Read them carefully. Okay, guys, let's go ahead and take a look at this one. And okay, good chunk of us got it right. Well, as the votes were coming in, we went down a little bit. We 56%. Yeah, this question is a little bit annoying. And I would say a question like this starts to fall into the weightlifting side, and that you have to kind of keep working your brain to kind of think through questions like this. It's not something that I can flashcard away for you, okay? But the more you do this, the better you get at it, okay? So let's just go through this one. Paisley Incorporated borrowed $2 million from State Bank on March 1st, year one, at a rate of 6%. According to the loan agreement, Paisley must pay principal payments of $200,000 plus appropriate interest every March 1st until the loan balance is paid off. Paisley has made timely principal and interest payments since the loan began, and then they want to know what the balance should be at December 31st, year three, okay? So the first thing you do is you say, okay, look, they borrowed $2 million, and they're going to have to do what? Every 3/1, there's going to be a payment. And the first payment, you don't make the first payment the same day you borrow the money. The first payment is going to be what? 3/1, year two. And that's going to be 200,000, right? And then they're going to sit here and they're going to do what? They're going to pay another amount at what? And we're looking for interest payable. They'll pay another amount at 3/1 what? Year three of 200,000, right? So at 3/1 year three, there's a $1,800,000 balance left there, and the next payment is coming when? I'm going to put it way down here. 3/1 year, that's year four. Why four? Not 44, but year four, okay, for year four. So the interest payable is going to be based on the what? Since the last payment, because they pay any principal and interest, they've paid that, right? And I'm trying to get now what's payable in that next payment in 3/4, the interest payable in that next year. So now I take what? Now I take the 1,800,000. What was the interest rate on this? 6%. Great. And it's how many months? It is 10 months. You got to count March because what? They didn't make that payment until they made the payment March 1st. So we have to count March as part of the accrual. So we're going to go with what? 10.
Isn't it 1.6 million?
Oh, I'm sorry. Yes. Thank you. Sorry, guys. Minus 200,000 minus 200,000 is 1.6. Thank you, James. Gives me what? 80,000? Okay. So you can kind of see, guys, why I'm saying, what can I tell you the flashcard here? Be careful, read carefully, work on your comprehension of this. Okay, I don't think you need a flashcard for that. There's nothing to really memorize in a question like this. It's more reading carefully, being the guy that sits there and tells somebody, well, it's not actually the 40th anniversary was last year, right? I mean, just develop that part of your thinking. That's something that you're going to have, that's an important rite of passage for the exam. And the way you get there, I call it weightlifting, which is working a lot of questions like this. Okay? Question? Okay, good. Keep working with those. You'll be fine, but you do need to put in the work, the time to get good at that. Okay? All right, let's talk about contingent liabilities. Okay? And basically, what GAAP says is in order for you to book a liability, credit a liability, debit a loss, we have to have a probable loss and we have to be able to estimate the amount. Okay. If we meet those two requirements, you will literally make a journal entry for a loss that hasn't occurred yet. Okay. The term contingency means we don't know the outcome for sure yet, right? Now, when we look at contingencies, they could fall in two other categories besides probable. They could be reasonably possible. If it's reasonably possible, they're going to ask me to at least disclose that. And if it's remote, I don't have to do anything. Okay, that's the basic rules as we go along. Now, we start out, however, talking about gain contingencies. And they say, hey, for a gain contingency, it's not recognized. Rule of conservatism, no journal entry, not recognized. However, you would be able to disclose information about a gain contingency, but there is never, if any time the exam says, and what should the company recognize, record, report as a gain contingency, the answer is what? Zero. Disclosure, yeah, okay, you can disclose something about that, okay? Okay, good. Now we come over and we talk about loss contingency. Rule of conservatism says, yeah, there are situations in which you will literally recognize a loss contingency. And in determining what to recognize, what to literally make a journal entry for, we look at these three categories: probable, reasonably possible, and remote. Okay, now let's just look at each one of these. Loss, okay, and they say if a loss as of the date of the financial statements, if it's probable, then you will literally have to go ahead and debit an amount to loss and credit an amount to the liability. Now, of course, that loss has to be reasonably estimated. We don't just go wild and start booking losses without having a reasonable estimation process. Now, if we can't come up with a reasonable estimate that we say, yeah, it's probably going to be this amount, then we would go ahead and we would book the lower amount of the range. And then we would disclose the range so that someone knows what could be between 100 and whatever this is and 250. But we would go ahead and do what? We would go ahead and book, debit the loss and credit the liability for the lower end of that range. Flashcard that. Okay? Got to be probable, got to be estimable. If it's probable and estimable, you should book it. If you're sitting there on your estimating going, between here and here, then book the lower amount, but disclose the range. Okay? All right, not very hard. Okay? Come over and let's see if the loss is reasonably possible. What should we do? Well, if it's reasonably possible, the rule is what? The rule is go ahead and disclose the nature of the contingency and the range, but no journal entry. You can write that down. No JE. We do not debit loss. We do not credit liability for a loss that is reasonably possible, but we do what? We do disclose, and you can see the rules around the disclosure there, so you can flashcard that. If loss is remote, don't do anything. No disclosure and no journal entry. No JE, no journal entry. I don't care what that stupid bubble stands for. Okay. Okay, good. Now we come over loss contingency example. And we've got this Alton is a defendant in a wrongful death suit. Thanks a lot. Thanks for making us think of death here when we're getting ready to end class, right? As a result of the death of an employee who was working on one of the company's production lines. The plaintiff filed suit in June and has asked for damages of $3 million. Alton carries insurance for potential claims of this nature. I want to underscore that because this is interesting, okay? of 1.5 million. Legal counsel for Alton believes that the judge will rule in the plaintiff's favor and that the company will have to pay 2.2 million, but the settlement could reach as much as 3. So what do? Since I kind of have a range, I book the lower end of that range because it's probable, and then I would disclose the range. But what I really want to, because you're like, well, okay, we understood all that before the example, but I think it's worthwhile to make sure that we're clear that insurance proceeds are not part of the consideration of the amount of liability and loss that should be booked, because that's now some sort of contingent gain, and we only do what? We disclose contingent gains. Okay. Okay, good. Come over and take a look at the next potential loss contingency, and if it is probable that there is an unasserted claim will be filed, we will still follow the same rules, okay, and have to figure out what is the probability of an unfavorable outcome. If it's probable, book. If it's reasonably possible, disclose. And if there's remote, you don't have to do anything. The only thing there is we don't have to tell our auditors about things that if we disclose the unasserted claim, we haven't been sued yet. And if we disclose something about it and amount of potential losses and whatnot, then all of a sudden we're encouraging the people that may be wanting to come after us to come after us. Look, they've already disclosed that they think they're going to lose, probably reasonably possible they might lose $2 million on this. Let's go get them. So sometimes, the company may not want to disclose all the details about something like this, and that, they're not obligated to tell auditors about stuff like this. Okay. Okay, good. Come over. Go ahead and flashcard this too, right here. You don't have to sit there and say, well, I felt the earth shake last night and I think the big one's coming, so let me put a loss contingency for that. No. Okay. All right. Premiums, warranties. Yeah, I think with a little bit of effort here, we can get through that part. And I like that because that'll get you through this module, and you can work on that over the weekend. Okay. So let's take a look. What's today? Thursday, right? Yeah. Okay. Premiums and warranties. Okay. So let's talk about what happens. And these are liabilities. We have to record this. Okay. So premium is basically, we say, hey, send in a bunch of soup labels and we'll give you, this cup and in exchange for the 10 soup labels you send in. So it's a way of driving sales, right? Okay, well, the company needs to estimate how many fools are going to peel off the soup label and send them in to get this stupid cup, right? And so we have to estimate the potential cost of that cup for the people that are going to turn in the soup labels for the cup or whatever. Okay, so when we do that, okay, we will have to figure out, okay, the total number of coupons issued times the estimated rate. I don't know about you. I never collect coupons. I just throw everything away. Can't be bothered to cut these things out. So a lot of people are like that. But some people say, no, look, 10 soup labels and I get this cute little cup. I want to do this. Okay. So they figure out that percentage and that becomes the total estimated coupon redemptions. And once you know that, then you just have to multiply that by the number of these little cups, the cost of these little cups that you're going to have to send out. And that becomes your liability for the premium here, okay? So what happens? We've got this AA Corp kicked off a promotion, including redeemable coupon on each can of soup. 5 coupons must be presented to receive a premium item, a cup or something, and that cup costs the company $2 to buy or produce or whatever it is. And they tell me that 70% of the coupons will be redeemed. Okay, so cans of soup, right? premiums that have already been redeemed, right? I mean, the number of premiums that have been purchased, and then the amount of coupons that have already been redeemed. Okay, so what do? I take the number of cans of soup, I multiply that by the redemption rate. That means I think they're going to redeem 1,050 coupons, of which 600 have already come in. Okay, then what? Notice that, by the way, the premiums purchase, guys, is irrelevant here. Okay, so then what? Then I go ahead and I go to the amount of coupons left to be redeemed, or 450. But in order to get the cup, and I'm making the cup part up, it didn't say that, the premium, they would have to give up 5 coupons. Okay, so that means what? I'm potentially going to have to buy 90,000 of these stupid little premiums, these cups or whatever they are, to satisfy these people that love this cup and are willing to eat 5 cans of lousy soup to get it, right? And so what happens? I sit here and I take the 90,000 times the $2 per, and you stick with my little cup example, and I debit what? Premium expense. I credit the liability. Okay, sort of a reading comprehension exercise. All right, good. Let's finish up with warranties, guys. Part of me says give you a break and get out a little early, but the other part of me says no, get you through this module so you can knock out the first part of chapter 5 over the weekend. Okay, so let's look at warranties. Okay, and warranties are seller's promise to correct product defects. Okay, and we create a liability and an expense, and we do that at the time of sale. What drives the warranty expense is the fact that you sold the stupid product that's going to have the defect, and you warranted to fix that defect. So you have to take the liability for the warranty at the time of sale. It's kind of like what? Like the allowance for doubtful accounts. What happens? You make a sale, you recognize how much you need to take in the allowance in the period of sale, and then later on, when the person comes in and says they can't pay, you don't debit the bad debt expense. Then you do what? You debit the allowance and credit the account receivable at the time they say they can't pay, but the expense is taken at the time of sale, right? Same deal here. We're going to take the liability and the expense at the time of the sale, and then we will recognize the liquidation of that liability as we actually have to pay out on that liability when the time comes. Okay, so go ahead and just flashcard that you take that at the time of sale, just so you remember that. And let's just go ahead and take a look at this example. This is kind of a fun example, and I think you'll see. Okay, so what happens? We have sales of these different amounts. Okay, and they tell me that the way these claims come in is 2% in the year of sale, okay, and then 4% the year after the sale, and 6% in the succeeding years. And that kind of makes sense because, the older the things get, the more likely they'll probably break and I'll have to pay for something, right? So what do? You take 2 plus 4 plus 6 equals what? 12%. And you take the what? You take the sales of 250,000 times the 12%. That's going to be my warranty expense of 30,000, and I credit the warranty liability of 30,000. I match it with the sale. Now you come along, and so far 10,000 comes in, and somebody says, "Well, wait a minute. They said that it was going to be, 2%. What? Doesn't matter. When a claim comes in, I pay to fix the stuff, whatever, credit inventory, credit cash if I have to pay for something. If I have to, pay my employees to fix the thing, I credit salary expense, whatever it is, and I debit the liability because now I'm making good on that promise to fix that stuff, right? Okay. Next year, right? I have sales of 5 times at 12%, set that up. Doesn't matter when, from what year, from whence the sale came that I'm paying on that liability, has no bearing. I debit the liability, I credit some asset, cash, inventory, whatever, as I'm making good on that liability. Okay. Next year, 750,000 of sales, I take the 12%, etc. Okay. Now, what a question might ask you is, well, okay, what's left in the liability? They like to ask that a lot. So what happens? Well, notice they took all the year's sales. That 1.5 is what? Is the total of the sales for the 3 years, right? Because they could give you all this in a fact pattern, right? Of course, if it's a company, you'd have to do it year by year the way they did. But for the CPA exam, if they asked you something like this, you would take the total sales times the 12%. So the total amount that would have been credited to the liability, 30, we can prove that right here, 30 plus 60 plus 90 is 180, right? And then whatever they've paid on that is the reduction of the liability. So they've paid on what? They've had an actual liability cost of 10, 20, 30, that's what? 60,000. So the amount of the liability would be 120,000. Okay. Question? Good. Let's do this. Let's do these questions and then call it a night. Okay, so I may go a little bit over. That's all right. Okay, so let's say I'm just going to give you a minute and a half for the first one and 2 minutes for the second one, and then we're going to be done. Okay. Okay, guys, I'm going to go ahead and end the poll here. You know, I get a little bit wondering when we see choice C, if you pick that one, I'd kind of be interested in why. Most of us got it right. I'm trying to figure out what rule might be in someone's mind that would make them think that C was the right answer. Basically, they say that the loss was probable, okay? And they had a reasonable estimate that the additional taxes could be 200,000, but as much as 300,000. And then they settled, I should say, for 275 after the statements were issued, okay? Now, I kind of understand why someone might have picked C. It's not the right answer because how can they possibly have put anything in the financial statements based on the 275 after the financial statements were issued. That's like saying, you know, I'm going to keep the horse in the barn after they're already gone. The statements are issued. I can't do anything now about it. 275 would be the correct answer. If the settlement came before the statements were issued, yeah, then go with 275. But once the statements are issued, they're issued. What am I going to do? Okay. Again, I don't know where 250 came from. Someone wants to say why they thought 250. Nobody picked D. The correct answer is 200,000 because that was the best estimate as they were getting ready to issue the financials. Okay. Okay, let's do, where'd my poll go? I want to take it away, but I can't find it. So just hit close on your poll and go ahead and do question 2.
Are you going to put the poll back up?
Oh, sorry. Yes.
Thank you.
There you go. Okay, guys, I know I promised 2 minutes, but I'm going to end it a little earlier for you. So take your best shot. Okay, and let's take a look. And okay, oops. I want to share results. And yeah, okay, well, I'm not sure why we're not getting close to 90% on this one, because the rule is what? If it is reasonably possible, that's that next category down. It's not probable, it's reasonably possible. And if it's reasonably possible, you don't accrue anything. You don't debit, you don't credit. You simply do what? You disclose and you show the range. And they gave us this best estimate, which I think was messing some people up with C. You can call that out as the best estimate as part of your disclosure and disclose the range, but you do not book anything. No debit, no credit. You do not accrue anything. No debit, no credit for reasonably possible. That only happens when it is what? Probable. Okay. Question? All right, guys, I'm not going to do that last one because it's more of the same with these contingent liabilities things. And I think you can figure that one out without my help. Okay. So, and of course, all the questions, you have the answers to all of them. If you want to look it up right there when you do your lookup in your homework in your software. All right. So chapter 4, knock it out this weekend. Don't mess around with it. Just get it done. Okay, chapter 4, get that consolidation stuff off your plate. that gives you then what? Monday, okay, so no Easter for you. Monday, you're gonna sit there and you should be able to get all the way up to module 3 for chapter 5. And then we'll pick up module 3 next time, hopefully knock out chapter 5 next time. All right. All right. Don't forget to, do a little Easter egg hunt and put some flashcards inside the Easter eggs. Okay. And have a good end of the week. And I will see you on Tuesday. All right.
Thank you.
Okay, good night.
Good night, guys.
Thank you.
Bye.
Thank you.